Assalamualaikum to Madam Suryanti. My name is Nurul Shafika Fatia. So I'll be explaining the first part, the first question. Record each transaction in the journal with explanation. So let me show you the. So basically, the on the first Jan account of cash, put debit 5,000, inventory 10,000 in debit, capital we have 15,000. On the third January, we have inventory account 8,000, account payable 8,000, credit. Then we go to account receivable 6,000 on the debit side. Cost of goods sold 3,500 on the debit side as well. Inventory is on the credit side 3,500. Let's move on to January 10. Rent expenses account we have 1,200 on the debit side. Cash 1,200 on the credit side. On the January 12th, equipment account, we have 2,500 on the debit side. Accounts payable credit side is 2,500. On the 15th January, advertising expenses 500 on the debit side, cash on the credit side 500. On the January cash account, we have 400 on the debit side, account receivable on the credit side 400. January 20th, we have office supplies. On the debit side, we have 500. Cash, we have 500 as well on the credit side. January 25th, we have cash on a cash account. We have 4,000 on the debit side. Sales revenue on the credit side for 4,000. Next, we go to cost of goods sold. On the debit side, we have 2,200. On the inventory account, we have 2,200 credit side. On the January 28th, account payable, 4,000 on the debit side, cash on the credit side, 4,000 as well. Let's move on to the explanation. So basically, 1st of January to record the initial capital contribution of 5,000 in cash and 10,000 ringgit worth of inventory by the owner to start the business. On the January 3rd, to record the purchase of additionally inventory on credit from the supplier. On the January 5th, to record the sales of goods on credit worth 6,000 ringgit with a cost of 3,500 and the corresponding reduction in inventory. On the January 10th, to record the payment of office rent for January in cash. On the January 12th, to record the purchase of a laptop on credit for business operations. January 18th, to record the payment of 500 ringgit in cash for an advertising campaign. On the 20th January, to record the purchase of office supplies worth 500 ringgit in cash. In January 25th, to record the cash sale of goods worth 4,000 ringgit with a cost of 2,200 ringgit and the corresponding reduction in inventory. Let's move on to the last one, January 28th, to record the partial payment of 4,000 ringgit to the supplier for the inventory purchase on January 3rd. That's all for me. Thank you. So I'll be explaining about the ledger for the first question. Let me share my screen first. So basically, I'll be explaining the part 1, question number 2. Post the journal entries to the ledger accounts, clearly showing a balance after each entry. So the first one, we have cash account. On the 1st January, opening balance, we have 5,000 debit, and the balance is 5,000 ringgit. On the January 10th, rent expenses on the credit side, 1,200, and the balance is 3,800. On the January 15, advertising expenses on the credit side, 500 ringgit, and the balance is 3,300. And on the January 18, account receivable, 4,000 ringgit on the debit side, and the balance is 7,300. And moving on to the January 20th, office supplies on the credit side, 500, and the balance is 6,800. On the 25th January, sales revenue 4,000 on the debit side. The balance is 10,000 ringgit 800. January 28th, account payable on the credit side is 4,000. Balance left is 6,800. Let's moving on to the inventory account. On the 1st January opening balance, 10,000 ringgit on the debit side, and the balance is 10,000 ringgit. On the January 3rd, purchase on good credit. So we put 8,000 on the debit side, and the balance is 18,000. January 5th, cost of goods sold, 3,500 credit on the credit side. And the balance is 14,500. And then next we go to January 25th, cost of goods sold. On the credit side, 2,200, and balance left is 12,300. Then let's see the accounts payable date. On the 3rd January, inventory purchase, credit side is 8,000 and the balance is 8,000. January 12th, equipment laptop. On the credit side is 2,500 and the balance left is 10,500. January 28th, cash payment, 4,000 ringgit on the debit side and the balance is 6,500. Next, we go to accounts receivable. On the January 5th, sales revenue, 6,000 on the debit side, balance 6,000 ringgit. And on the January 18th, cash, credit side, 4,000 ringgit, and the balance is 2,000 ringgit. Let's move on to sales revenue. January 5th, sales on the credit side is 6,000 and the balance is 6,000 ringgit. On the 25th of January, sales cash. On the credit side, 4,000 and the balance is 10,000 ringgit. Next, we'll be going to the cost of the goods sold account. On the 5th January, inventory, 3,500 on the debit side, and the balance is 3,500. And moving on to the January 25th, inventory, 2,200 on the debit side, and the balance is 5,700. And then we go to rent expenses account. On the 10th January, cash, 1,200 on the debit side, and the balance is 1,200. Advertising expenses account. On the 15th January, cash, 500 on the debit side, and the balance is 500. On the office supplies account, on the 20th January, cash, 500 ringgit on the debit side, balance 500. Equipment account, on the January 12th, account payable, 2,000 ringgit, 2,500 ringgit on the debit side, and the balance is 2,500 ringgit. I think that's all from me. Let's move on to the next question.
Assalamualaikum and good day, Madam Suryanti. My name is Muhammad Shifa bin Muhammad Rozi, and for my part, I will be explaining about the part 2, which is for the adjustment, and we will moving on to the question number 3, which is for the journal entries. And okay, the journal entries reflect adjustment for January 31st to ensure accurate financial reporting course. And they include recording accrued wages of 600 ringgit for unpaid wages, adjusting prepaid rent by 600 ringgit also to recognize rent expense for February, and recognizing depreciation expense of 41 ringgit 67 cent for a laptop, and setting up an allowance for doubtful debts with a bad debt expense of 400 ringgit. And these adjustments align expenses and revenues with the appropriate accounting period. So that's all for the part 2, question number 3. I will continue my explanation for the part 2, which is for the ledger account. The question is post the adjustment journal entries to the ledger account, and the ledger entries provide a detailed breakdown of the financial adjustments made on January 31st, categorizing debits and credits for each transaction. These include recording 600 ringgit for unpaid wages, under wages expense, and accrued wages, adjusting 600 ringgit from prepaid rent to rent expense, recording 41 ringgit 67 cent for a laptop depreciation, and recognizing 400 ringgit as a bad debt expense with an allowance for doubtful debts. And the ledger organized these adjustments to maintain a balanced and clear financial record.
So hello, my name is Grace. So I'm gonna explain about adjusted trial balance. The adjusted trial balance is a key financial tool used to verify the accuracy of an organization accounting record after adjustment have been made. It ensures that the total debit match the total credit, providing confidence in the correctness of the financial data before preparing financial statement. So step taken to prepare the adjusted trial balance is for first step is posting adjustment. Adjustment for accrued wages, prepaid rent, depreciation on the laptop, and an allowance for doubtful debt were recorded in the journal and then posted to respective ledger accounts. This adjustment reflects a more accurate financial position of the business as of 31st January 2023. Second step, by transferring balance. Balance from all ledger accounts, including cash, inventory, receivables, payables, and expenses, were brought into the trial balance. Both adjusted and unadjusted accounts were included. For the third step is ensuring accuracy. The total of the debit column equals the total of the credit columns, confirming the double entry principle has been upheld.
Hi and Assalamualaikum everyone. My name is Putri Nazia. Today I will explain about the statement of profit or loss for the QPS Trending Sendian Berhad for the financial year 31 January 2023. I will walk you through the key components including sale, cost of goods sold, expenses, and the resulting net profit. Company reported the total sale of 10,000 ringgit. Since there were no deduction, the next sale remained the same 10,000 ringgit. This represents the total revenue generated from the operation during the year. Next one is the cost of goods sold. The opening inventory was 10,000 ringgit. Purchases made during the year amounted 8,000 ringgit. After adjusting the closing inventory of 12,300 ringgit, the total cost of goods sold is negative. The cost of goods sold is negative 5,000 ringgit 700. This calculation results in gross profit of 4,000 ringgit 300, which is the difference between the net sale and COGS. Now let's examine the expenses. The total expenses amount 1,842 ringgit, broken down as follows: the rent January of 600, accrued wages 600, advertising 500, bad debts 1,000 ringgit. Depreciation is 42 ringgit. The expenses are deducted from the gross profit to determine the final net profit. After subtracting the expenses from the gross profit, the company achieved a net profit of 2,458 ringgit. This indicates that QPS Trading Sdn managed its costs efficiently while maintaining a positive bottom line. In conclusion, this financial statement highlight QPS Trading Sdn Berhad ability to generate profit despite the unusual adjustment in COGS. The company demonstrates strong financial management by keeping expenses relatively low. Okay, hi everyone. Next one, I will explain about the statement of financial position for the QPS Trading Sdn Berhad of the 31 January 2023. This report give a company asset, liability, and also equity at the end of the financial year. The company owns office equipment for value at 2,500 ringgit after accounting for accumulated depreciation of 42 ringgit. The next value of the office equipment is 2,000 ringgit, 2,458 ringgit. The current asset the company has totaling the 2,000 ringgit, comprising the closing inventory 12,300 ringgit, account receivable 2,000 ringgit, prepaid rent among the 600 ringgit, office supplies 500 ringgit, cash 6,800 ringgit. Altogether, total asset amount the 24,658 ringgit. Next, we have the liability, which are split into current liability, which is the account payable 6,500 ringgit, wages payable is 600, allowance for doubtful debt is 100 ringgit. The total current liability is 7,200 ringgit. Now let's examine the equity section. Owner capital is 15,000 ringgit. Retained earning, which include the net profit of 2,458 ringgit, bring total equity to 17,458 ringgit. When we add the liability of the 7,200 to the equity of 17,458 ringgit, the total match the company total asset of 24,658 ringgit. This balance confirm the accuracy of the financial position as of 31 January 2023. In conclusion, this statement highlight QPS Trading Sdn Berhad solid financial health with the balance and positive equity position. The company asset management and carefully monitoring.
So I'm gonna explain about bank reconciliation statement. A bank reconciliation statement is prepared to identify and resolve any difference between the bank statement balance and the company's cash book balance. These discrepancies arise due to timing difference and omission or errors in recording transaction. The reconciliation process ensures that the cash balance reported by the company align with the bank statement balance. As of 31st January 2023, QPS Trading received a bank statement showing an ending balance 6,800. However, after comparing it with the cash record, the following discrepancies were identified. For first one, deposit in transit 1,000. A deposit of 1,000 made on 31st January was not reflected in the bank statement. This is a timing issue because the deposit was made late and will only be recorded by the bank in February. This amount is added to the bank statement balance. For the second one is outstanding check 500. A check issued by the company on 30 January for 500 had not been cleared by the bank as of 31st January. This is another timing difference as the check will only reduce the bank balance when it is processed. This amount is deducted from the bank statement balance. For the third one, bank service charge. The bank deducted 50 ringgit as a service charge directly from the company account, but this charge was not yet recorded in the company cash book. This adjustment must be made in the cash book to reflect the accurate cash balance. For the fourth one, return check. A customer check of 300 deposit on 28 January was returned due to insufficient funds. This means the company had incorrectly recorded the check as cash received, which must now be reversed in the cash book. The adjusted bank balance and the adjusted cash book balance are both 7,300, confirming the reconciliation process was successful.
So the last question for part 5 is the journal entries. The journal entries for January 31st record two transactions, which is the first one is recognize Rm50 ringgit debit to bank service charges and corresponding credit to the cash at the bank account. This is reflecting the bank fees incurred, and the second record is 300 ringgit as a debit to accounts receivable and a credit to the cash at the bank account, indicating a payment made towards outstanding receivables. And these entries ensure accurate tracking of expenses and also the cash flows.
Assalamualaikum to Madam Suryanti. So I'll be explaining for the part 6, question number 10. Let me share my screen first. So the first 50 units sold are taken from the January 1st purchase price at 100 each, resulting in a cost of 5,000 ringgit. The remaining 20 units sold are taken from the January 10 purchase price at 110 each, resulting in a cost of 2,200. So basically the 50 units times 100 equal to 5,000 ringgit, and the remaining 20 units times 110 equal to 2,200. So the COGS equal to 5,000 ringgit plus 2,200 equal to 7,200. So this is your cost of goods sold under the FIFO method. This method reflects the floor of inventory costs, ensuring that the earliest purchase inventory is used up first in the calculation. I think that's all from me. Thank you.
So the next one is for the part 6, which is the value of the ending inventory using the FIFO. FIFO, which stands for the first in, first out. Assume the oldest inventory are sold first, leaving the most recent purchases in stock. We have 3 inventory purchases from the 1st January, 50 unit at the 100 ringgit each. January 10, 30 unit at RM 110 ringgit each. January 20, 20 unit at the 120 ringgit each. A total of 70 units were sold, leaving an ending inventory of 30 units. Our goal is to calculate the value of the remaining 30 units using the FIFO method. Under the FIFO, the oldest inventory is sold first. Each remaining unit come from the most recent purchases. Firstly, we identify the remaining unit from January 20. All of the 20 unit remain, value at 120 each. From the January 10 unit remain the value at 110 ringgit each. For the second step, we calculate the value of the remaining inventory. 20 units times with the 120 ringgit equal to 2,000 ringgit 4,400. And for the second one, 10 units times with the 110 ringgit equal to 1,100 ringgit. The total of value of the ending inventory is 2,400 ringgit times with the 100 and 1,100 ringgit equal to the 3,000 ringgit 500 ringgit. This method is particularly used for the business during the period of rising price, as it reflects the current market value of the inventory more accurately. To conclude, FIFO is straightforward and commonly using the method for inventory valuation. It not only simplifies accounting but also ensure the inventory value closely reflect the latest cost. So that's all.